Alright, welcome back to our next episode of our Nuggets on the Go. So today we're going to talk about a few key important answers to some of the questions that you guys have sent in through our insights@plb.sg email. We welcome you to send more questions for us because we love to answer your questions on Nuggets on the Go. So let's go. Alright, so for this particular episode, we're going to answer a few questions that we have from our audiences. Before we dive into some of these key questions, I want to show you some very cool charts that our PLB tech team has developed over the past weeks. So the first one will be this cooling measures vis-a-vis the property price indexes. And we're going to make this available on our propertylimbrothers.com. There's going to be a segment called Analytic Tools. You can then head in to play around with some of the key features of this. So some of them are interactive charts. For example, like this one, this is an interactive one. What we want to showcase over here by our PLB Nucleus team is basically all the cooling measures that has started since day one. So for example, you get SSD number 1, LTV number 1, and then you get LTV number 2, and then you can track all the way until the latest one, which was commenced from 16 December 2021, ABSD round number 4, LTV round number 7, and then TDSR round number 3. We have also inserted the duration of previous cooling measures, like how long they lasted before a brand new one kickstart. That is also in correlation with the different indexes. So for indexes, over at PLB, we always like to look at these 4 indexes, basically the landed index, the non-landed private property index, basically condos and apartments. We also like to look at overall all private residential properties, which is a combination of landed plus condo and apartment. And also want to look at the correlation of private properties vis-a-vis HDB apartment properties. Over here, of course, one way of looking at the cooling measures is that technically speaking, what has happened in Singapore is that even though with rounds and rounds of cooling measures, and all in all we have like 10 over rounds of cooling measures. So what has happened to the price index even amidst the introduction of cooling measures? So the very first perspective is that the very onset and the neediness of having cooling measures in the first place was because there was so much hype and speculation and activities and interest in our Singapore properties, and which was why our government decided to introduce cooling measures to ensure that we do our best to try and lower down the level of speculation, the level of flipping of properties, which was why SSD came out and then ABSD came out, because there was so much foreign interest from foreign investors that want to buy our properties. So technically speaking, the needfulness of cooling measures was because of the fact that if we don't do that, price appreciation is going to be out of hand. And what that might happen for our future generation is that probably the income inequality gap is going to be so huge that only the rich and the top tier people, the top class people, are only able to buy properties, private properties, and then the gap is so high that private properties are likely going to be out of reach of Singaporeans. And thus, cooling measures in a sense is to prevent over speculation and over fast-paced appreciation. But I think the core message is that our government still wants our property price to gradually increase. And I think the bare minimum for real estate to perform is that it must keep pace with inflation. Because if property prices don't keep pace with inflation, what this will mean is that when your property price stagnates, and we always have this mantra right here in PLB, is that risk is at its highest point when you purchase a property that does not appreciate over time, and the appreciation has to at least be able to fight inflation. And thus, if your property don't even appreciate inflation, if inflation is at a certain percentage year on year compounding all the way over the next 10 to 25 years, if it doesn't keep pace with that, then technically speaking, this particular property is not a good purchase, it's not a good investment, it's not a good choice. I think the bare minimum coming back is to keep pace with inflation. But of course, the best thing is that your property price, if it outpaces inflation, it appreciates much faster than that in a shorter time frame. Then of course, there's a lot of things that you can do. One of the things is that you can extract equity to enjoy the value of a property without selling it. The other one is that of course you can divest your property, you can purchase one under your name or spouse name, or you can invest in commercial properties and things like that. And of course, you can also extract equity in the sense of divesting your current property and buying a bigger property. So coming back to this graph, what you will also notice is that even though there's so many rounds of cooling measures, the price trend right now of where we are across board was higher than the last peak, which happened in 2013. So a quick recap, if you have not been following our Nuggets on the Go, was that there was an episode that we talked about the 2013 difference and the key reason why TDSR technically changed the psychology and changed the behavior of condominiums and apartments configuration since 2013 because of TDSR and because of the quantum effect. So you can click on this to look at that particular video where we talk about TDSR effect. Coming back to this, price has superseded the last peak, even though we have so many rounds of cooling measures. And actually, cooling measures in another perspective is quite a beauty. Why is it the beauty? Is that it technically is a protection and a moat around the Singapore property segment when it comes to residential property. Why is it a moat? Is because it has technically made real estate stable in Singapore, but it's still appreciating gradually. And of course, with the recent trigger event that happened in 2020 because of the COVID pandemic, it has then even triggered more different kinds of behavior that propel a lot of families to look at bigger properties. And of course, that push plus construction shortage on the base level for HDB apartments and BTOs has also pushed HDB apartment prices upwards in the resale market, which then further pushed the OCR condos, RCR, CCR, and the landed properties as well. So why is it a moat? Back to the question, is that it has made real estate purchase and sale more stable because the moment somebody's buy, they are coming with a mindset to hold it for at least 3 years because of the seller stamp duty. And the base effect is that if anything were to happen, for example, right now, at the time of shooting, it's March, and of course, there's war ongoing currently in Ukraine. For example, if something would happen to the markets, property price indexes started to drop, for example, what is going to happen, technically speaking, is that our local government can then release and relax some of the existing cooling measures because we have so many rounds of cooling measures that we can technically tweak them to relax it, to resuscitate the property market. So in a sense, cooling measures from this perspective is a form of a moat around the Singapore real estate market. Now, let me just bring on this particular chart as well. So this is very suitable if you're very interested in a landed property in 2022. So what we have done is that we have toggled between freehold and leasehold based on these two graphs. We have also toggled, the moment you click on it, you'll be able to see the volume vis-a-vis the price index right here. You're also able to see leasehold in terms of its volume vis-a-vis its price indexes. And on the right hand side, you can also toggle between strata homes and pure landed homes. So you just need to toggle these two buttons. You can see in terms of the median price index vis-a-vis the volume as well. And then you can further segmentize into planning zones, whether you want to look at freehold, leasehold behavior, you want to look at brand new from developers or sub-sale or resale. And of course, the terrace, semi-Ds and detached, right? Let me just have a look at this chart together with you. So what technically happened is that if we were to look at leasehold and freehold in terms of relationship, the very first thing is we can look at this portion right here. So when freehold price escalates and increase, especially after the Lehman Brothers crisis, you'll notice that it hits like an uptrend in a very short time period, all the way from 2009, and the burst up towards like 2013. In this just short 4 years, basically in terms of the average median PSI price was from $719 all the way to about $1,295. So it appreciated in a very short time span, very quickly. But what happened to the 99 years landed properties? Basically, what happened was that it followed suit and it also escalated upwards all the way from 2009 in terms of its price index from about $606 per square foot averagely all the way to $1,000 per square foot averagely in terms of leasehold. And maybe you might be wondering, hey, I thought when buyers buy landed property, they always hunt for freehold 999. Now, that's not very true because landed properties also cater to families that wants to work within a set of quantum budget. So some of the families, they might love the landed property, they want the amount of bedrooms and size, and they like the concept of living in a landed home, multi-generation and all that. However, they have a fixed set of budget and affordability quantum, and thus 99 years landed always follow suit in terms of price movement uptrend based on the movement of freehold properties. If freehold drops, then naturally leasehold property prices will also follow suit as well. So when we look at that, you also need to look at the amount of volume in terms of its percentage relationship. So naturally speaking, you're right if you're saying that a lot of people love freehold properties or triple nines property more than 99s, because if you were to look at the relationship between two of them, you would definitely see that the blue bar is much larger than the yellow bar. Based on 2021, both 99 and freehold has seen an upsurge in terms of transaction volume. The key rationale is because there was so much interest in landed homes that you see this surge since 2019 all the way upwards till today. And in terms of volume, it escalated from 2020 to 2021. The 99 years landed disparity effect, you can still buy pure 99 years landed for, I think about if I'm talking about the Loyang region, you can still buy something at 1.4 to 1.6 region. If you talk about some of the other 99 years pure landed properties, you can still buy them for close to about 1.6 to 1.8 in other OCR region as well. Right now, it's almost impossible to find any landed properties that are 99 years below $2 million. It's almost impossible. Everybody is asking for 2 mil upwards. And why is that so? It's because same behavior happens. If, let's say, example, if I were to be owning a 99 years landed property, and I've been seeing news and looking at the charts of all the freehold properties that are escalating upwards in pricing, and maybe my aspiration is that I might want to exit from a 99 years landed and shift to a freehold landed property for my family. And when I see that shooting upwards, I naturally will not want to sell my 99 years landed property at $1.6 million anymore. I would naturally want to challenge the price. I want to see how much I can challenge to shift it upwards to a higher bar. And of course, when I look at one tier below me and I look at some of the 99 years condominiums around my estate, starting to ask in terms of their 4-bedder pricing and the new launch pricing of 4-bedders, inching upwards towards the $2 million mark, naturally speaking, I also don't want to sell anything below $2 million. So now, what is happening in the 2022 market is that 99's pure landed properties has already moved up in terms of overall quantum pricings. And thus, that then busts the myth of whether 99 years landed property can see appreciation or not, because it all depends on whether the upper tier kind of asset has moved up or not. So there's always something pulling up the other party. So in this scenario, pure landed property has pulled up the pricing, and thus the net effect is that 99 years landed property are thus being pulled up together as well. But there's always a gap in between two of the pricing for the market to make sense, because all buyers and sellers are savvy in the market. And of course, we're in a free economy. The market will balance off itself in terms of our behavior and choice-making behaviors. So these two charts, I'll leave it to you to enjoy on our website. I think we'll make it available within the next 30 days. You should be able to access it if you head on to propertylimbrothers.com. Today, we want to talk about this particular question that we have. Let's have a look at this chart. We have one question coming in from more of our audience writing to insights@plb.sg. So once again, if you have any questions, I'll be very happy to answer them. You can just email us straight on, and then we'll try to answer in our next few episodes. So basically, the question goes like this. The particular audience has been contemplating to move to a private property. This family, based on husband and wife's combined income, they have the ability to move to a private property. Basically, also back in the same estate. So they have been living in the first HDB property that they bought from HDB. It was a BTO flat. They waited for the keys after about 3 to 4 years, MOP'd in 5 years, and they continue staying there for another 5 years. So right now, their HDB property is hitting its 10-year-old mark. Of course, something to know about HDB versus private condo is that your tenure only starts from the date that you collect the key. So it's very different from private properties, whereby your tenure starts from the date the land was being given and awarded the 99 years. There's one small little benefit that HDB apartments have. Right now, their HDB apartment is 10 years old. Over the past few years, they've been contemplating, hey, should I move up to an OCR condominium? And they are also looking at either a 3 or 4-bedder. So 2 questions. Should they move? Dual income, they are able to afford. They've already checked with their bankers. They can loan up to a range 3-bedder or 4-bedder. Max loan quantum, they can loan up to 2 million, which means that if I were to use this very simple calculation, take 2 million, base it off 75%, they can buy something around maybe the range of about 2.4 million. Example. So coming back, what should they do? I think end of the day, if you're talking about your own stay property, the very first advice that we always give is that make sure that this move is something that your family is agreeable, your family is happy with the move, because at the end of the day, you don't want to force through a decision that both spouses don't agree. So of course, we want to make sure that the family is happy first, right? Then the decision will come in on many different factors, right? So moving up can be a partial investment decision, because technically speaking, when we look at the context of where we are in Singapore, we look at many various different factors. One factor that we always look at is that what's going to happen in the next 8 years. When we look at this, in about 8 years time, there's going to be 1:1 ratio for Singaporeans and foreigners. And of course, when we then look at this chart again, we look at the amount of HDB properties that we have in the entire island, which currently is at about 1.2 million HDB properties. And then condominiums is occupying about 340,000 right now, landed property 73,000. And in terms of its ratio right now, when you look at that, the only category that everybody is eligible to purchase, of course we don't bring ABSD into the question, is condominiums and apartments. So basically it's private residential properties, landed properties on mainland reserved for Singaporeans, HDB reserved for Singaporeans or PRs that have gotten PR for 3 years and married and things like that. However, based on all the population in Singapore by 2030, 7 million, this category right over here is the only category that everybody can purchase without much restrictions. When we look at the demand and supply kind of context, what is essentially going to happen in 8 years' time is that if you will want your asset, your real estate is technically one of the largest assets in your life. You're going to service the mortgage in terms of principal and interest every single month. This is going to be the largest investment in your life. Would you want an asset that belongs to an asset class with a more limited amount of supply at about 300 over thousand, maybe by the time we're hitting 400,000? Or would you want your asset to be something that's in the 1/million kind of range in terms of overall supply in the overall market? So which one would you want to be in? And looking at supply, 340,000, 1.2 million. Looking at demand, this is a full-on 7 million people. Of course, there are micro permutations because out of the 7 million, of course, not everybody can afford private properties. We need to disclaim that as well. And of course, over here, mainly it will be Singaporeans and PRs that are eligible to purchase HDB properties with further restrictions as well. Just a very simple, basic demand and supply kind of concept. That might be one of the decision factors that you might want to look at in terms of demand and supply, because economic fundamental is that when there's lesser supply but there's more demand, price appreciation tends to happen at a higher possibility rate. And of course, the next thing that we want to look at is that there's this concept that I want to draw in this graphic right here, is that if you have the capability to move on to your private property, and we need to also disclaim that we always share with our clients that we don't want any families to overexert yourself in terms of monthly servicing or mortgage, because take note that your monthly mortgage is something that you must make sure that you are able to substantiate. It's always good to have a buffer, 12, 15, 24 months of maybe CPF funds or maybe balanced cash funds to ensure that you don't have to worry for the next 2 years in the event if you were to be out of job for a little while hunting for a new job, or unfortunately you will retrench and things like that, right? So you want to make sure that your family is safe and taken care of. However, if you do have the ability, the second key consideration is to make an observation in terms of HDB apartments, because HDB apartments were built for the main purpose as an own stay property. It's not for the purpose of an investment property. And that's a direction that our government wants everybody to understand as well. Any paper gain that you made from the day that you purchase your BTO or you resale HDB, even if it appreciates 250, 350, 450,000, that is technically trapped paper gain within your HDB property. So that paper gain amount gets trapped underneath your HDB property and you cannot release it. The only way to release it is to sell it. However, when it comes to a private property, you can release the equity through other means. If the property would appreciate, for example, if you were to purchase a private property for $1.5 million, it appreciates to $2 million, you can extract the equity without selling the property, without killing the golden goose. You can extract it through equity arrangement with the bank. You don't have to sell the property. You can continue to stay in the property. When the equity is being extracted, that is technically as if you were to sell it, because you're extracting the paper gain out of it. Your monthly mortgage will increase, but you're technically extracting the capital without selling your property. However, for HDB apartments, you must sell it to enjoy the gain. And that's a key fundamental difference. And when we talk about real estate investing, in the event, let's say if you are in another country, for example, let's say if you're in US, there's no additional buyer's stamp duty. Technically speaking, what a lot of real estate investors are doing is that they don't sell their property. They hold on to their real estate. When it appreciates the extra equity, they purchase more property and they hold their real estate, because real estate is definitely, through history, outperforming inflation, and they will let their real estate continue to appreciate gradually. And when they accumulate 3, 4, 5 properties, it appreciates at the same time. That is a huge difference between HDB apartments and private residential property in Singapore. So that's the second thing that you can think about. You can talk about it, discuss, and make sure that your family is comfortable. And of course, we ourselves also will try to think through what are some of the roadblocks sometimes when it comes to a decision whether to switch from a HDB apartment, if you have the ability to do so, is that if you want to have like a play safe kind of scenario, very easily you can come up with a time horizon. What do I mean? For example, let's say if you and your spouse right now, you are 35 years old, draw a timeline and ask yourself, what is the age that both of you will want to tone down in terms of your lifestyle? That means you want to tone down at a period whereby maybe most of your kids, they are already in university, they are starting to get their own occupation, planning for marriage and things like that. What is the age? Will it be 55, 60 or 65? Let's say for example it's 55. Then make a decision at 55 in advance that from 35 to 55, you will do your best to service and move into your private residential property. But at age 55, you can choose to divest, sell off your private property and move back to a HDB apartment. So you can still move back to a HDB apartment, it's just that it's 20 years later. Or maybe you can choose another scenario is that you can plan for age 65, because at age 65, that'll be the year that your private property is fully paid. And by then, use the amount that you have already fully paid off the whole apartment, assuming you bought it at 1.5 million. And worst case scenario, 20 over years later, let's say it doesn't appreciate. Worst case, just do a worst case scenario. And it's still at 1.5 million. Touch wood for you, all right? But based on inflation, it should be by 2 million by that at least, right? So if it's like still at $1.5 million, but your property is fully paid, take the $1.5 million, take out 600,000, pay off a HDB apartment, live in it happily ever after. And of course, you still have 900,000 in terms of your balance reserve to substantiate your lifestyle for the next 20, 30 years through a retirement years or the years that you want to slow down a little bit more. So that is the third way of looking at it. What is the fourth way of looking at it? The fourth way is to understand that our time horizon to be able to invest in the private residential property is very short. Why is it short? Because your best years in terms of income ability and loan tenure longevity happens to happen when you are young. And it happens to happen when you are in the age bandwidth of 20 over years old to 30 over years old and of course to about 40 years old. The moment you step into a later bandwidth, and let's say if you decide to enter a private property, you will then find that in terms of the money mortgage, the difference is so huge. So let's take a comparison right now on these two charts. If somebody at their age 35 decided to purchase a $1.5 million property, they can still loan 30 years because we take 65 minus 35. That's the maximum loan tenure. Based on $1.5 million, they take a 75% loan based on the current interest rate of let's say 1.4%. And then compared to somebody in age 55 and they want to invest in a private property or move to a private property, they only have 10 years tenure. They can stretch to 75, but they have to down pay a higher percentage in terms of loan. Let's say if they want to take a 75% loan, they have 10 years. Have a look at the key difference in terms of the monthly installment. And when we further break it down into principal and interest, the fundamental key difference right here as well. So with that, what does this mean is that if you were to enter earlier on, technically your monthly servicing in terms of your mortgage is less stressful than if you were to enter later, assuming both persons right here in both scenarios wants to take on the 75% mortgage leveraging. Because of the fact that we're limited by our tenure longevity, this is the fourth thing that you can think about. What should be the fifth thing that we need to think about? And probably we'll end off after the fifth thing right here is that the final choice is always yours. On top of looking at all these different factors, fundamental factors, economic factors, or maybe mindset factors, is that will your family be happier if let's say you were to move into a property with some facilities for your kids to enjoy while they're still in their school going years? Because maybe in the weekends, you can bring them up to the pool and things like that. You can work out at the gym. And of course, if you look at some small, minute differences, for example, for the couple that probably, I don't know, maybe you have 2 cars that is under HDB apartment estate. Maybe you're already paying like close to $200 for your season parking. And of course, when you look at getting in the condominium, the MCSD fees includes 1 to 2 parking and things like that. So small little things for you to do some comparison. But end of the day, of course, do your fundamental financial analysis to make sure that you're prudent prudent, that you have planned forward for at least the next couple of years to ensure that you can substantiate and don't overstretch yourself in terms of the maximum loan quantum as well. Do some planning, do some buffer, and ensure that your family is comfortable to proceed. End of the day, I think the important thing is also to refer back to one of the episodes previously. I think it was 4 episodes before that we talked about the 8 inherent characteristics of a true real estate as a form of asset. And we hope that this particular episode in NOTG will benefit you. Thanks for staying tuned with us. If you are listening this on the road, on Spotify or Apple Podcasts, thank you for supporting Propertylimbrothers NOTG over the years, and hope that you drive safe, and we'll see you on the next episode. Meantime, take care. Shooting upwards. Sorry. Cyborg.